The first 3 months of 2022 were challenging for equity and bond markets. Growth stocks experienced the majority of the pain. The tech-heavy NASDAQ index was the worst performer, down 9%. Bond markets experienced the worst quarter in 40 years, with the Barclays benchmark indices down 4.5% to 6%. Although the S&P 500 was down overall for the quarter, energy stocks rose nearly 40% alongside higher oil prices. The Russian invasion of Ukraine sparked a ban on Russian oil imports in many countries, including the US. Oil prices, which had been rebounding from pandemic lows through 2021, saw a dramatic spike in the first quarter. Prices for wheat also jumped, as Russia and Ukraine are both large exporters of wheat. Although the price-to-earnings ratio of the S&P 500 has declined from the recent high of about 23 times, valuations remain elevated when compared to the 25-year average of about 16.5. Central bankers, politicians, and consumers are now all focused on inflation. The Consumer Price Index, or CPI, hit about 8%, the highest level in 40 years. Core CPI, which strips out volatile food and energy price changes, rose to about 6.5%. Some of the factors driving higher inflation might be considered transitory. For example, the recent spike in food and energy price increases can likely be attributed to the war in Ukraine, and supply chain issues affecting semiconductor availability is driving up prices for new and used cars. We might see these inflation components return to normal if things stabilize. However, price increases in the cost of services and shelter might be stickier, driving inflation higher for the longer term. One of the reasons service costs are increasing is the very tight labor market. Although total non-farm payrolls have still not recovered back to pre-pandemic levels, job openings have surged to over 11 million. In order to attract employees, companies are increasing wages, leading average hourly earnings to rise over 5.5% year over year. Supply chain problems have persisted, especially as goods demand surged. Shipping costs remain elevated more than 2 years since the start of the pandemic. Businesses are facing higher costs for labor, raw materials, and shipping. Thus far, most companies have passed on price increases to customers, protecting their margins. This has also led to price inflation. At a certain point, consumers will no longer be able to absorb these increases, and inflation will lead to demand destruction. Retail sales have remained strong thus far, but we are watching these numbers very closely and monitoring management commentary for signs of weakening demand. The bond market has responded to rising inflation and the Fed's focus on getting it under control. Rates have surged in the first 3 months of the year. The 10-year yield hit 2.72%, rising 120 basis points in the first quarter, while the 2-year yield rose over 150 basis points. The primary driving force behind increasing rates is the Federal Reserve's abrupt change in messaging. At the end of 2021, the Fed was projecting 1 or 2 rate increases in 2022. However, as inflation pressures ratcheted higher, the Fed pivoted toward a more restrictive stance and is now projecting a total of 7 rate hikes in 2022. In addition to the rate hikes, the Fed is embarking on a period of quantitative tightening. The Fed is projecting a reduction of its balance sheet of about $3 trillion over the next 2 years, reducing the amount of liquidity in the markets. The inflation that began building during the pandemic has been exacerbated by supply chain issues and the war in Ukraine. The Fed now faces a difficult task of bringing inflation down without tipping the economy into recession. In this environment, we believe value-oriented companies with strong balance sheets and pricing power should outperform.